get out and you're going to be right every single time. And you're going to think, you're just going to go to your head too.
Right. Yeah, I guess what I was wondering is, I know you've been in the market for quite a while. Not sure if you've been doing options all this time, but I think you have been for a while as well. Just curious if you're able to survive in this market and stay in the green. I guess is that kind of the rite of passage, if you will. You know,
There's no reason you shouldn't be in the green in this market right now. The market's not going down.
well, true.
Why would you not be in the green?
Well, a lot of people are not, I'd say.
Well, they're probably not doing, they're not listening to our live stream. That's the problem.
Well, or they just bought in recently and the market tanked right after.
Yeah, but that's,
I agree.
like, you don't buy in the market, you don't buy in the VTI and VU and then sell it a week later. That's a long-term hold position, right?
Yeah.
Start DCing your way in, buy $1,000 every week or something. You know what I mean? Buy $500 a week, buy 25, whatever you can afford, and keep adding to it. Like that's, those things will make you rich. It's just a matter of time. But if you think it's not going to go down, then, that's, you shouldn't be investing, I guess.
Yeah. Learn how to make 1% a month. Yeah, learn how to make 1% a month and build from that. Because 1% is pretty doable in just about any condition. And then you can get comfortable with it.
Yeah, 1% a month you can do in your sleep. And you can do it on SPY or QQQ, straight QQQ or SPY. Super simple, super easy, super safe.
Yeah, whenever I get frustrated, I back the way the hell off and just go for something simple like that and let the confidence build back. And like in February, I dumped everything because it was all going to shit for me, and I'm just now getting back. So I'm up about 5% for the year. So but I took a huge hit back in February.
So that February hurt you big time then, is what you're saying.
Yeah. Well, that's when I had that surgery, and that took me out for about a week, and then we had that ice storm that just absolutely tore up Texas, and I had absolutely no power for 3 days, and by the time I got back to stuff, it was all in the toilet. And I just sold it all and decided to start over fresh.
Yeah, Jerry and I took losses too, but ended up with a positive month. So, and that's, me being safe. And I was safer back then than I am now, which is kind of funny because I have to be more aggressive now because the premiums just kind of dried up because of the damn VIX. But, I don't have as much shit on either though, so I don't know what the fuck's going on.
Yeah, probably.
When you guys
in terms of, go ahead.
So when you guys talk about, doing 1% a month on something like SPY, do you guys typically apply the same strategy for SPY? Because it's, they have a lot more weekly expirations, or do you still do like 30-day?
Depends on how passive you want to be. I would look for how much money you need to make to get to the 1% and then find a strike that'll get you there. I would be okay with 10 to 15% probability being in the money. That's where I'd be okay on SPY.
Gotcha.
How much percent in the money, potentially?
Anywhere from 10 to 15% is where I'm comfortable on SPY.
Okay.
It should get you over 1%.
Do you use the same rule for, say, QQQ or DQQQ or?
TQQQ, I use a different method. When the market's down, at least 1%, I usually open up some TQQQs, then it goes back up, and then I just buy it back. But honestly, I would be using TQQQ to get assigned those shares if the market tanked, right? To like, had a 20 to 30 or 40% correction, or I guess 40% was a correction at this point. It's freaking bear market crash, but I would use that to get assigned and then try to go long on those.
Do you find that, I don't know if this is true or not, but is TQQQ more volatile, and let's say if it drops, is it more risky than QQQ?
I wouldn't depend what you call risky, or I think they drop. If it drops, QQQs drop 1%, TQQQs are going to drop 3%, right? It's just leverage, it's built-in leverage. That's what makes it risky. It's not that it's going to drop 2% if QQQs only drops 1.
So you'll find that your strikes will be a lot further down the option chain when you're selling TQQQ because of that.
And you need to take that into account. 10% down move in Qs is not 10 strikes down in TQQQ. You got to go down 30.
But what's the benefit of then getting into TQQQ? Is that just the capital?
It's just another premium generation machine or whatever. But the thing is I don't mind taking ownership of those shares. In fact, I want to take ownership of those shares down at 55 or 35, right?
Mm-hmm.
Would you want to take ownership of TQQQ over QQQ?
Yeah, I just said I want to take ownership of TQQQ. But I only want to take ownership if the market's dropped 20 to 30%.
But would you prefer to do that instead of taking ownership of QQQ, if you had the choice?
Yes.
Absolutely. Look, if you look back at March when we had that 30% decline, TQQQ fell to almost $17. And if you could have just got in there, you would have quadrupled your money in less than a year. That's the TQQQ is for playing the recovery.
It's for crash recovery, right? It's not gonna, you don't want to be in TQQQ permanently, in my opinion. I think Matt Money does, and I disagree with that strategy. To me, it's like you want to play it on a crash recovery. That's the only reason I would ever use it.
So you'd only be long as you see a recovery happening. As soon as you think we're pretty much recovered, you'd be done.
Well, if we drop down 40%, look how fast it happened, right? We dropped down in less than a month, 40% roughly. It was a little bit less, and we recovered less than 60 days. That's what you want to use TQQQ for. You don't want to use TQQQ for a long-term bleed upwards, right? Long, slow.
Yeah, when I said you could have quadrupled your money, that was a long-term thing. I would have probably been out at a double. I can't hold on that long.
So when you have a market drop like that, would it actually make sense then to actually buy the stocks, the TQQQ stocks themselves?
Absolutely.
Okay.
Yeah, I would be buying 100 shares. Well, I'd take ownership of 100 shares of TQQQ, right? Or how many other contracts I have.
Gotcha.
Okay, let me ask you another question. If going back to my QQQQ puts that I sold today that were at the money, if you were in my shoes and you didn't want to take assignment and you were waiting for this thing to go up and just buy back, how much? Where would you buy back? What percent profit would you buy back in? Given that it is risky and I did buy at the money.
If you didn't want to be in it, I'd try to be out of it either now or when you're even. But that's with the preface that you said you don't want to be in it.
Yeah,
Right? The game, name of the game.
I like Dave's no assignment strategy. I mean, I think that's great. I mean, you can just never get assigned and just keep selling puts on companies.
Then you can't follow Randy.
I guess you can do a hybrid. You can do some stocks where you get wheel or get assigned, and I don't know. I'm not comfortable with Randy's strategy. That's just me. Like I don't know what he never shares his fucking portfolio, but I don't know what positions he's in. You know, maybe he's in
I used
freaking
to all
Procter
the
Gamble
time, man.
crap. Maybe that'd be okay.
I used to put it out there all the time. I'll put it out there anytime.
Well, I can't comment on your positions because I don't know what you're in.
Yeah.
Some positions I would be okay with selling at the money probably and running some sort of situation where I would get assigned and wheel it, but I wouldn't be doing that with a Tesla or anything like that.
Yeah, no, I'm not doing it with Tesla. I'm doing it with IBM and KMB and
Okay, so it's all dividend
Kodak. Hmm? I'm
all
doing,
dividend paying stock,
yeah,
right?
that's exactly what I'm doing. All with aristocrats, mostly. Yeah, if you look at PPC Ian's 50 top, I used about his 25 top. Those are the stocks I own, or the puts I have.
Yeah, Randy, I was going to copy your triple M today, and I was thinking, I'll start with triple Q and see how that plays out.
Yeah.
That would be a strategy I would consider doing. So definitely it makes a difference, right? Because Randy can just throw it out there. Yeah, I saw the money, but there's got to be context there behind it to understand what the strategy is. The strategy is not meme stocks. The strategy is on basically blue chip companies, big, large, conglomerates or whatever you want to call it. And that I'd probably be okay with that. The problem is if it goes against you, then what are you going to do then, right? You're going to take a big loss because most likely the cover calls ain't gonna be worth shit, right? If it drops down 10% or 15% or whatever, cover calls ain't worth shit. You're going to have to wait on time or you take a loss, and that's dead money. That's dead freaking money sitting there.
Yeah, I don't really look at it as dead money. I can roll it for a couple of months, and if I come out with 7, 8, 9%, I mean that's way better than it's going to get sitting in a bank or something.
Well, I don't think that you can roll it very easily. There's no premium to roll down, so you have to roll way the hell out, is my guess.
Yeah, but it's a little bit different when you're doing it after money. There's premium still there.
And you're also talking about rolling when you just told me you would take assignment. So what strategy are you doing?
It just depends.
Basically a hodgepodge freaking bowl of freaking, I don't know. Tell me.
Yeah, you got to be flexible with this shit because it's the criteria changes day by day. Like who would have known that everything would have dumped today after they made that little news announcement? I mean, I was about breaking even on the day, went to $10,000 negative in a matter of 10 minutes. You just can't predict that crap.
My account was down like $200, so there you go, folks. There's a difference between 10 grand doing that the money versus me doing what I'm doing.
Yeah, but I'm also hitting $5,000 and $6,000 a day, almost every day. That it's all positive. It's all
Well, I mean, right? Like you have a lot more risk on, so there's a lot more money to be made there, right? the problem is you have to understand there's do you just want to freaking, get hit by the ball and take your walk or get, occasional walks, finally get to the home plate, make some money, or do you want to hit grand slams all the damn time? Or try to hit grand slams all the time?
Well, that's just it. I'm not trying to hit grand slams. I've got this spread out over 120 contracts. So, I mean, it's crazy what I'm doing to try to get diversified.
Yeah, but the thing, Randy, is all it takes is DES futures or the SP 500 to drop 10%. It'll affect every one of your positions.
Sure,
Everyone.
Sure it will.
So the diversification.
I'm curious, what would it take?
In that case, it only helps if we got sector rotation, right? Which doesn't happen all that often.
That 35 weeks out of the year, I'm going to be right. I just have to worry about the other, 15 weeks or so, where I got to do the dance.
Randy, I'm curious, if you were to get assigned on your 120 positions, have you ever run the numbers to see how much capital you need? Or is that not a relevant thing to think about?
If things went to total crap, I'd start buying my positions back because I couldn't take delivery of all that stock. There's no way. It's way margined.
You got 50% or still?
At buying power, but that's not the same as actually having to buy the stock.
Yeah, I know, but how much margin are you actually using, or how much buying power are you using?
About half, about 250,000.
Okay, I mean that's fine. Yeah, you couldn't take ownership of all of it. If you get margin expansion, if everything dropped, and he doesn't. And my guess is he doesn't have 120 positions. He got 120 contracts, so my guess is it's probably like 20 to 30 positions or something across those 120 contracts.
Let me look.
Just post the damn spread. Post the portfolio.
I've got 101 contracts. Well, there's no easy way to count the number of positions.
Sounds like you need a script.
Yeah, I'm not going to count them up right now, but there's 101 positions. And I can post my holdings out on there tomorrow if y'all want to look. I got no problem with that.
Not 101 positions, 101 contracts.
Yeah.
Go big or go home, right, Randy?
What's it?
I think you go big or go home. That's your strategy.
Yeah. I'm not trying to go over big. I'm just trying to go to the size of my account.
I was in a bunch of stuff today. I was in Boeing, a lot of Boeing actually, and so I was up last week. I was up like $1,000, and for some reason this week I've just been down, and I just decided that enough was enough, and I put in a limit order where if I were to close up like $200 or $300 profit, I just closed, and I put that in today. Like half an hour later, I get an alert that it had closed, and like 15 minutes later, Boeing tanks again. So luckily I got out of that.
Doesn't sound like you're doing the correct strategy or using the options the correct way. Well, at least what we think. Like the name of the game here is theta decay, right? It's all about getting in a position, letting that theta decay work in your favor, right?
Well, I mean, I did really, really well with Boeing when I sold the puts initially. But these were long dated puts. These were for August, I think. Was it? Oh, no, June. These were for June 18th. I did 11 puts on Boeing, and I was doing well. I was doing I made like I was up $1,000, and then all of a sudden I was down $1,000, like a week later. What I think I should have done, I mean, I think perhaps I got lucky with Boeing, but what I think I should have done is I should have bought to close. I mean, that's one of my things. I never know when it's time to close. A lot of the time I'll be up and then I'll just wait. I'll be like, well, you know what? I'll wait another week or two and let it decay even more. And then it turns against me. And that's what I've seen happen like the last week or so.
Yeah, you just have to constantly be evaluating the market because it's going to change on you from day to day, even hour to hour.
It's not. I just think the mindset's not correct there, Knight Rider. You're saying I was doing well, right? I don't think that's the right mindset. Because if something goes against me, I'm still doing well. I don't really give a shit if it goes against me, honestly. All I care about is whether or not it gets tested and goes into money. That's all I care about. So I just let that theta decay work. So I don't know if that mindset is correct. I'm doing well this week. You know what I mean? Like it doesn't, you're almost like in your head, you're trying to day trade it is what it sounds like. You're trying to get into it and hope it goes up right away so you can buy it back at a cheaper price and make profit. But that's not the correct way to look at it unless you're trying to day trade options.
Well, I mean, I guess when I say I was doing well, I mean, things were going really well. I sold, like I said, I sold Boeing. A week later, I'm like up 1,000. I sold QQQ. Like 24 hours later, I'm up 10%, and I sold like, I don't know, maybe 7 positions on QQQ. And I'm up 10%, and I'm wondering, you know, everything's going well, but until things get tested, you never really know. And I guess now I'm learning that I have to be a little bit more careful. Slightly tested, I guess, barely tested. I mean, as soon as I started seeing red, I was like, well, I need to think more carefully about my strategy.
Well, if you're doing it at the monies, then, you know, I mean, it doesn't really going to take much to go red, and it's going to screw with your head, right? What Jerry and I are talking about here is we're so far down. Honestly, the stock can move down 2 or 3%, and sometimes it doesn't even affect us at all. You know what I mean? Especially if it's been a day or two, we might actually be in the green. It's kind of, you know, if you're doing it at the monies, it's going to play with your emotions. You definitely have to get used to that.
But
I've
think
actually never done it.
understanding, Knight Rider, you're saying you were being tested, but being tested in a case of options trading, in this case, is getting close to your strike price, which you were not even close to.
I guess when I say being tested, I guess my emotions were getting tested more than anything. Yeah, I don't really ever sell at the money. In fact, I have never ever sold at the money until today. For the first time, I sold 2 QQQs, and they're 3 weeks out. I think one of the big mistakes that I was making was that my puts were very far dated. Like we're talking, for example, Boeing, I sold 11 of them, but they were at $200 for June 18th. I mean, I think that's relatively out of the money. I would think that would be safe, but you know, if Boeing tanks, you know, I'm screwed. How do I pick my strike price? Well, I look at the, I try to wait for a down day, and then I just look at, I kind of go, not midway between the limit, between the bid and ask. I try to go a little bit higher than midway, and I set it, and hopefully it gets filled, and usually it does. I don't know if that's the correct way or not.
But the problem is Boeing. I just don't see Boeing getting back down to that 160 to close that gap, Jerry. Not unless there's a plane crash or multiple. So I think on do it, but I just don't. I'd rather be out at like 30 days or something like that at the most. But I don't think it's a bad strike though. Go up for June. I mean, it's only 2 months away.
I think the better question is 11.
1,000, 2,000. Sorry, go ahead.
I think the better question is 11 contracts the right size to get in? For
You got $2 million portfolio.
Well, right, but that was my point. I think in the chat that we had it wasn't necessarily that the 200 strike price was the problem. It was the scale of the position.
Here's the thing. When I had a little bit more cash, and then I used a lot of it for VTI and VOO. So. And the reason I bought VTI and VOO is, well, I thought, you know what? If my puts don't do well, at least VTI and VOO will do well. And my thinking was, see, I opened a paper trading account and I put some money in there. Well, not money in there. There's fake money in there, right? So I bought VTI and VOO and I left it, and like over 2 months or 3 months or something like that. And it went up like 15 grand. I didn't do anything there. And I thought, okay, well, then VTI and VOO is a good way. I'll use VTI and VOO, and I'll try to play with the options and make money that way. But if I were to get assigned VTI and VOO at $200 a share, 11 contracts, I don't have that kind of cash available, and I'd be going into margin, and I wasn't sure if I could handle that. And I had a lot of other options going on. And the market was tanking, so wasn't ready. And when I say tanking, when you're heavy into margin, if you get assigned, I mean 1% drop during the day is like, I don't know, it's devastating potentially.
Yeah, the paper trading account. I mean, that's kind of funny how you used it. So you put VTI and VOO in there and the market just goes up. That's a bad example. I tell people just use a paper trading account for mechanics, right? Because honestly, once you put real money on the line, it completely changes, right? Have you ever played poker with fake money, right? Have you ever gone all in on stupid pair of deuces? Right? You probably did, right? So paper trading account, like it pretty much probably gave you the confidence. Oh, well, shit, VTI and VOO just goes up, right? That's probably the idea that it gave you, right?
Yeah.
The thing is you're in VTI and VOO or you're in one or the other, and that goes down 10%. Your puts are most likely you're going to get assigned, or you're going to be tested. Your strikes are going to be tested. No doubt about it.
Yep. And I wasn't willing to get tested on Boeing at 11. I mean, if I had 2 or 3 of them, it would be a different story. But at 11 and a bunch of other things, I mean, I was, in a risky position, I think.
Position sizing is important. Strike price is important. Diversification. Big thing too is emotion. It seems like I think if you're going to continue in this options thing, you definitely got to control your emotion.
It
Because
kind of gets, yeah.
You
Sorry.
don't have to deal with emotions. That's the great thing about what we're doing here. You can be wrong and you're still right. That's why this whole strategy works to begin with. Because you don't have to be right, right?
I'm just saying, if you're going to do a Randy thing and you got problems with emotion, then that's not going to work.
Well, that's it's a different level, different strategy, different, you need some big nuts for that.
Yeah, it kind of gets to your head when you sell. I mean, like I said, I sold some QQQ puts. I sold like 7 of them, I think, or something like that. And 24 hours later, I'm up 10%. So it kind of gets to your head, and you're like, well, I guess I can't do any harm. You just keep going and going and going until, oops, you're in trouble.
So,
And now I'm in a position where I'm actually scared to put on any puts. Until I put on Randy's today.
so Dave, actually, I found another good use for a paper trading account. It is to actually deal with, I get the itch and I'm not 100% confident or comfortable with trying it out. I just go to my paper trading account, put that on and see how it does.
I disagree with that. 100%. It's not going to help you at all with your emotions.
Well, it satisfies the itch.
Maybe. I mean, strange always helps with that too, I guess. But I just don't see how that would help, honestly. I mean, it's fake money, so most likely whatever you put on in there is going to go up. And it's going to totally screw up when you actually put a real trade on and it doesn't work in your favor. It's going to piss you off.
Right. Well, I think there's something to be said for individuals who have been in a trading space for a while and been in the market for a while versus having people who are getting into it. Newer traders tend to overtrade. And I know that from personal experience since I started trading recently. So being able to still learn how to execute trades, being able to put on trades and see how they do versus actually then risking real funds. I think there's a lot of benefit for newer traders.
I think trading small and more often is a little bit more easier on you. I'm doing, $60 trades here, $100 trades there. If you go down 100% on a $100 trade, what is that? $200? I mean, it's $100. I mean, it's not. It looks bad when you're looking at it, but if you step back and look at it, it's like, okay, I'm down 100%, but that's only $60. It's not. It used to bug me. It used to bug me back a few months ago. But now it's like, okay, I got time. Because you still have that time on your side when you put on a contract, unless, of course, it's 1 day to expiration.
I just say if you're having a confidence issue, just go with 5% probably of the money on a safe stock. Make some money. Don't go far out because you're going to be sitting there, if it goes against you, you're going to be sitting there for a long time freaking, oh man, look at this, and it's red for a long ass time. It's going to piss you off. Every day you log in to look at it. Go out 2 weeks. 2 weeks it's over with, right? It's going to decay and you're most likely going to make money. It's just build up confidence like that.
5% of the money, is that 0.05 delta?
Not always. It's close. Delta.
So how do you figure out the percent in the money?
You have a broker there.
With Interactive Brokers.
There's a formula for it, but you gotta have a broker that has it, or you gotta use a website, or you gotta come up here, build a script like I did, or
Interactive Broker.
Delta gets you close.
Delta gets you close, but Interactive Brokers has it as well.
Yeah, it's kind of a roundabout way.
Yeah, you kind of have to turn strategy builder on, I think. And
it's not very convenient to use that for, you can't look at all the strikes and just pick one out. You got to go in there, click on this, okay, pop this up. It's very inconvenient.
Knight Rider, do you have access to other brokers like TD Ameritrade?
No, right now I'm only with Interactive Brokers.
But if you're able to open up a TD Ameritrade account, maybe I don't think you even have to. Well, if you want to get real-time data, you probably have to fund it a little bit. But they give you charting, and you can also get those metrics from there. That's another way to do it.
Oh, okay, okay. I'm curious, Dave, how do you figure out the percentage of the money? Do you just use the bot?
I have a script that I built that uses all the criteria to calculate that. So it's using IV, it's using shit, I don't know, it's the last time I freaking looked at that script. It uses about 3 different criteria to calculate that. Current price, IV, and it's using days to expiration to calculate the probability. You have a spreadsheet you can do. You just have to, look up all that information and stick it in there.
Do you use it every time, or do you just look at the delta, typically?
What?
Do you use the script every time, or do you typically just look at the delta with Interactive Brokers?
Depends on what stock it is. When it comes to some of the ETFs, I just use the delta. I don't even bother with the script. Some of the script checks is the earnings at the same time, so it has more uses, but I've been lazy sometimes, especially on the ETFs.
Yeah, I was looking at that Theta Gang script, I think it's called. I wasn't able to, I'm on Windows, but I didn't figure out how to use it. Didn't figure out even how to install it. Couldn't.
Yeah, it takes some a little bit of knowledge on some Python. I mean, Windows is a whole other ballgame. I've never run Python on Windows, so I don't know. But you need to install Python and then configure the TOML files, and then if you're using, you gotta have IB Pro because it's using the API.
Yeah.
And they're using the IB Gateway too, so that's a whole other ballgame. Setting that up.
Yeah. I guess we lost Dave.
No, he had to run.
Oh, okay.
All right. Well, this was a lively conversation.
Yeah, lots of fun.
Absolutely.
How long has this Discord chat been going on for? How many weeks, I guess? A year or two?
About 2 months.
Oh, okay. I like it. I hope your puts go down in value, right? Yeah, down in value tomorrow, so I can buy back too. Randy, or QQQ,
Yeah, I don't know. Just
the
have
ones
to wait and
you
see.
sold today.
I wouldn't
Yeah.
pretend to guess. I have to wait and see what they do in the morning.
Yeah, who knows?
How's
It's been kind of unpredictable the last few days.
the pre-market is showing green so far, but let's see what happens in the morning.
And also,
Randy, I'm curious, what would... Yeah, go ahead.
and I look at it too. Like I got 30 days for it to come back, and all that time, it's gonna have theta decay working for me. So it's like I'm not worried about the Qs at all.
Yeah. Assuming the market doesn't just collapse or implode, unpredictably, which it could at any point in time. Apparently, it's super overinflated. But
when that happens, we're gonna have bigger issues. I mean, I'm gonna just be heading for the hills and hunkering down when we get a total collapse.
yeah.
I won't recognize it right at first, but after a day or two, I see it coming. Take my lumps and go hide.
Yeah. I'm curious, Randy, what would what kind of return, do you have a goal in mind in terms of percent return per year or per month that you'd like to get? Or are you just doing everything that you can to get the highest possible return?
Last year I hit 97%, and the year before I hit 86%.
That's impressive.
Now I am nowhere on that track this year. I'm at about 5 or 6% right now, but I've got all those gains from last year that kind of cushion it.
Wow. Why aren't you up as much as you were last year? Is it a different market?
It's a different market. IB changed some rules on me. They won't let me run Tesla the way I used to. Because I was super concentrated in it.
I remember when I first started learning about options, I was thinking of selling puts on Boeing. Boeing was doing really badly. I was thinking of selling puts on Boeing. Boeing was at like 160, around 160. And I was thinking of selling puts on Boeing 130. And I was like, I was going to sell 5 or 6 of them for maybe a month, 2 months.
Yeah, see,
I'd make $3,000, and I did.
I don't like that strategy.
I was just learning.
If they're doing poorly, it's going to come down and test you. I want to be selling puts that take a dip but are overall going in up direction for the long term. But
yeah. But I mean, if I were to have been assigned, let's say if I was assigned in, what was it, probably in August or so, July, August, if I was to get assigned Boeing at say 130, at that time, I'd be up like 70, 80% if I went long on those stocks. So it would have been great. But I guess it depends on the company that you're selling the options on. If you get assigned on something you don't like say, for example, NEO or some other meme stock, it might backfire on you.
Yeah, sure, there's all kinds
Maybe it's a question you better ask. Go ahead, Randy.
There's all kinds of ways to play this stuff. It just depends on your personality and how you want to do it.
Yeah. Yeah, I mean, if you're just getting in like me, I think you got to be a little bit more careful. I think I need to be very careful moving forward. I'm curious, Randy, where would you decide to close the QQQs from today? Would you close them at 10%, 5%, 100%? Where do you decide that it's time to close?
Probably when we're hitting 40 or 50%.
Okay.
Or if I run out of time, it's to the end of the contract and it goes to going in assignment, then I'll just roll it out.
Hmm.
And I would
try
to do that on the last day of the contract, because that means you're rolling out less intrinsic value or extrinsic value, or whichever one it is. But you get a better deal by doing it on the last day of the contract.
I didn't know that. Okay, so being proactive here and rolling, say 2 weeks ahead is not a good idea. It's better to wait.
Yeah, because when you're rolling it 2 weeks out, then you're paying for that 2 weeks of time value. So you want to let that run off, and those next 2 weeks, your stock price may be up enough that you don't even have to roll it.
Yeah.
Bernie, just to make sure I understand it, you're saying, for example, if you have a 2-week expiration contract, it would be actually better to get you like the last day before expiration to roll, because you're then not getting back all of that premium if you were to say, try to roll 5 days before expiration.
Well, you have to do some math. Sometimes it's okay to do it prior But you have to take the price, the strike price, plus the premium left. And if it's close to the share price, then you're okay to roll. But if there's more value there, then you can wait. Because by the time that goes to the last day, that value goes away, mostly. Because the last day, the strike price plus your premium price usually adds up very close to what the share's trading for now, if that makes sense. But if you did it before that, the difference between those two will be a lot higher. Does that make sense?
It does, yeah.
Okay, so let me give you a scenario. Okay, let's say I sold a put for Tesla like 2 weeks ago, and I sold it at say 650, and today it's at 640, and it expires, let's say, next week, and next week it's at 610. Where would it have been better to roll?
Well, there's no real way to answer that. You just have to go by the information that you have available at the time. It's like you can always you can always play this what if games, and you'll never come up with an answer. You just have to take the best it's not advice, but all the factors, and make your best decision at the time. The one thing with options, you have to be able to make decisions quick. If you need to go study them, you need to go somewhere else. So I don't spend more than about 5 seconds deciding on whether I'm going to keep or sell an option. There's no wishy-washy trying to figure it out, worrying about this, worrying about that. Just do it. Chances are you're going to be right. You may make mistakes, but just keep your position size small so that your mistakes don't hurt you.
Yeah. Randy, do you have a minimum that you need to make on a contract or position?
No.
Or are you fine, say, making $30 here, $20 here, $100 here, that kind of thing?
Yeah, I don't really go for those. Usually I like $7 or $8 per contract.
Nice.
You also trade stocks that actually have that premium, like Amazon, right?
Yeah, I do Amazon a lot, Tesla a lot, Home Depot, the bigger stocks, yeah.
Yeah.
Mostly I like to be in the $300 to $400 range of the stock price. They'll seem to have a decent premium and enough to keep me interested.
Yeah. The thing I really like about Amazon, for example, even when using credit spreads, is the theta on those positions is so high that you can actually burn the premium down pretty quickly. But with the size of the account you're actually trading, you get the added benefit of not having the other leg on it. So
yeah, that's.
Is that what theta is? Pretty much, is it the measure of time value?
Yeah.
Theta, yeah, basically it's how much premium gets burned away, every day.
Interesting. So and that's interesting. So if you want time to work on your side or in your favor, look for a high theta position.
Well, you got to be careful, and this is where you got to really learn, some of the Greeks if you want to use them. So if you go farther out than I think like 30 days, that's where beyond 30 days your theta is going to be much smaller. That's why places like Tasty Trades, they actually recommend you get into positions anywhere between them, and then as soon as it gets below 30 days time frame, your theta grows, which means that the premium starts burning down much quicker.
Okay, but here's my problem. Here's kind of why. Here's what my initial strategy was. Right. Let's say I want to sell puts on Boeing. Let's say I'm happy buying Boeing at say 160. I'd be happy to buy Boeing at 160. If I sell a put on Boeing for 160 in the next 30 days, the value is maybe like maybe $20. But if I sell it 3 months down the road, it might be like $200.
Right.
And I know that Dave is against long dated puts, but I mean, if I'm selling Boeing, if I'm making $20 a contract, that's nothing.
Right.
How do I balance that?
Well, what you're doing, this is just my opinion, of course, man, to each his own, but what you're trying to do is you're chasing the premium, which is where you can get really hurt. So you should, in my opinion, and this is something that I've learned for myself personally, I only started trading options in January myself of this year, is that when I did tend to chase the premium itself, because you can get closer to at the money and get higher premium. That's one way to do it. You can go farther out, but you add risk to being wrong, right? Essentially. Plus, you lock up the money for that duration of time as well. And so you're really chasing premiums at that point. What you really could do is start looking at different stocks, where they are, different industries, seeing what happens with them, and then looking for where the premium is versus picking a stock and then looking how much money you can get for a particular position that you might be interested in.
Okay, but let me give you an example. For example, let's say Apple. I mean, Apple's a good company. I'm sure most people would be happy to and comfortable selling puts on Apple. If you sold a put on Apple, say $90, I think a lot of people would be comfortable owning Apple at $90 a share. Right now it's like 130, I think, maybe 140. I think 130. If you do that in the next 2 weeks, for example, you're going to get almost nothing for it. But if you do that 3 months out, you're going to make a lot more. And if you get assigned, you get assigned. But I don't know. I don't know how to balance it out, I guess. You
Right.
make almost nothing.
But you're talking about then doing almost like a long-term hold strategy, right? And if that's your strategy, then okay, that can potentially work for you. But if you're looking to actually make an income, if you will, then that's probably not the most efficient use of your funds.
Mm. Okay. Yeah.
Again, my opinion, I'm by no means an expert.
I appreciate the write-up you did for me on Boeing the other day. I was
Yeah,
able to get out of that thing, luckily.
right. And to be honest, it's one of those things that it doesn't take a lot of effort to do. I literally went on FinViz. Yeah, it gives you the news. You go on Benzinga, look it up. See what people say there. TradeView to give you a chart. And with a few of those sources, you can get all this information quickly. So.
But you know what? All it takes is one plane to crash, and Boeing is not. I think it's a pretty poorly made plane. Makes a poorly made plane, especially lately.
It doesn't even need to be that complicated. It's Biden saying something on the news.
Yep.
So there you go. It can screw you even more.
Yeah, I found that out firsthand. I mean, I thought buying the S&P 500 was a fail-safe way to make money. And 2 weeks later, I'm still down $1,000, and that really shook me, to be honest. I really felt that. And that's when I started wondering about my Boeing and all the other companies, all the other puts I'm selling.
Yeah, but I think what Randy said also is a good recommendation. Where once you kind of get impacted by one of your trades in a way that shakes your confidence, you should have to go back to your safe trading roots, if you will, right? So it could be just do small, trades where you get at least a little bit of premium, but get that back into your normal routine, and then start getting back into more trades that potentially make you more money if that's what you're interested in doing. But don't let it scare you to the point where you're using emotions essentially to trade in a way that actually will crash your account.
What do they call it? Diamond hands or something like that?
Yeah, I'm diamond handing Tilray right now.
Yeah. Give me an example of something you recently sold. I'm curious what your strategy is.
Well, right now I have, let's see, 1, 2, 3, 4, 5, 6, 7, 8 different positions with probably maybe 10 contracts total. So I have Virgin Galactic, I have, what is this? I forget what it stands for, OXY.
Oxy something?
Occidental Petroleum Corp. I have Netflix. I'm in Mara. I have DraftKings. I have RK. So RK I've been rolling since February. So, but again, it's one of those things where I got in when it was around $155 strike, or $155 per share, and this is right around the time frame when the market just started, dropping. And I got in at 135 strike, and I've been rolling it since. I've rolled, let's see how many times. I think 2 times, no, 3 times. And I've made money every single time I rolled. So there's, for me, as long as I have enough capital in my account and I'm making money off of it, I'm okay holding it because I think it's going to get back to, that price again. And if I'm able to make, $100 or $150 for the size of my account right now, I'm totally fine with continuing to roll as long as I can get enough premium out of it. Now, when it gets to a point where I can't make enough premium, at the very least, my cost basis was reduced from 135 down to 129 right now. If I can get it down to, I don't know, 127 to 126, 125, whatever, then I can probably employ the strategy that Jerry was talking about, which is, I can close that position and then just open up 2 puts on it just at a lower strike price to see if I can recoup some of that money. So.
Would you say, do you think you made a mistake on ARC, or do you think it's...
See, that's the thing. I can't say when you, it's when I make a decision to get into a position, I have to be comfortable with being assigned. That's the thing. So if you're playing with stocks that you just don't like, don't get into the stock because you're going to potentially get assigned 100 shares of that stock, and then what are you going to do? So, for example, the closest thing that I am to in terms of being in a stock that maybe I wouldn't bought into otherwise is Tilray. I have 200 shares of that right now. And my position's down over $1,000, on that. But you know what? I'm okay because I think every day I can do covered calls on it. And eventually I think it's going to go up. Worst case scenario, it doesn't go up, but at least I'll use covered calls as a way for me to reduce my cost basis and then just get out of the position. And that's it.
Mm-hmm. I'm curious, what would be a reasonable ROI for you per year or per month or that kind of thing? And are you just trading options, or do you have buy and holds as well?
I'm not doing buy and holds right now, and a reasonable, return on my investment right now is anything that's greater than zero. And the reason I say that is this: I started trading options this year, and with my trading right now, if in a period of a year I come out with zero on the other end, I've essentially paid with whatever I ended up doing for my education in options trading. Going forward, I know I will use that experience to be able to make money in the long run anyway. So, where else can you go get free education besides YouTube?
Do you see it as a way to potentially beat the market? I mean, is that what you're trying to do by trading options?
I mean, at the end of the day, I want to retire early.
Yeah.
So I'm not interested in, and this is my way of being able to position myself to be able to do that exact thing. So I want to turn this into my income strategy as well as being able to fund, my retirement.
Sure. I'm curious. Do you know how much you're up for the year since you started trading? Do you know, or your, not your how much you're up, but your I guess your percentage?
Well, my realized gains are probably around $1,500 right now.
Okay. And what's your I mean, are you up 5% for the year, 2%?
Well, for the size of my current account, which I, by the way, didn't start. I funded it, much later in the year, close.
Yeah, you're kind of like me. I started pretty late as well.
Yeah.
I was looking at. I wish I started trading. I was trying to learn for the longest period of time. I was trying to learn all about options, and I kind of missed out when during let's say this time last year when things were really nice, and through the summer.
Yeah, I mean,
kinda-
hindsight 2020, right?
Yeah.
Yeah. So, I just did a quick calculation. I'm about 4% up on my account.
Okay.
So,
Okay.
I'm not
I think. Okay. I think you'd be up higher if you were invested in the S&P 500.
I could be. I could also be at zero if I just had it in my savings account.
Agreed. Yeah.
So, or, I could, if I invested the same amount of money in VTI, for example, sure, I would have gone up to a certain amount. But again, the way I look at this is, for me, I'm actually investing in my education right now. So with me getting the education that I'm getting right now, and plus being up 4%, yeah, I will take it any day.
I agree. I mean, I think your goal is to outperform the S&P 500 and the market in general. But
My goal
I don't
is
know.
to beat Randy.
Yeah. I think you have to do more of his trades then.
That's okay. I have to get up to his account size first.
Fair enough. Fair enough.
That's the other big learning point is that I started off with a $5,000 trading account, and I quickly learned that it can be very dangerous and very easy to lose all of the money you put in there. Because I don't know, Randy probably heard me say this, but I'm not sure if he remembers. I actually used to, with my $5,000 account, I did 5-0 DTE SPX trades. So I don't know if you if you know what that is, but
No.
well, SPX is essentially 10 times SPY.
Ooh.
Right, and it's basically zero day DTE, which is you buy into the position and it expires the same day.
Wow.
So you gotta basically time it correctly. And I was doing iron condors on top of that, which basically means that I did 2 credit spreads, one on the put side and the one in the call side, right? And you gotta make sure that the stock closes, between the 2 ranges, right? So, and if one of them goes the wrong way, well, my account would have been gone.
Wow, yeah, it's risky. Risky. I don't know if it's important or if I should be learning iron condors and strangles and short strangles and all that stuff. Yeah, I didn't learn how to do any of that stuff. I'm just doing straight cash secured puts. That's all I'm doing. And I think the only thing I need to do or the thing I need to focus on more is doing what Dave is doing. I think for me, for my peace of mind, I think unless the caveat here is unless tomorrow, QQQ spikes tomorrow and I make a killing, and I get addicted to Randy's way of doing things.
Right, but that's hope, right? You're not using analysis per se. Randy is doing his trades, and Randy, correct me if I'm wrong, but you're doing it based on your experience and your level of trading that you've done in the past as well. It's not just something that you feel like it's going to go in the right direction.
I usually go
Yeah,
I usually go one strike out of the money. So basically, I'm on a coin flip with a weighted coin. So I mean, I could easily go either way, and I would just have to deal with it one way or I did. It just depends.
Right. Right. But you also, like you said before, you actually get into your trades being okay getting assigned, and the tickers, the symbols that you actually get into trades with are the ones you're okay holding, right? So it's not like you're just hunting for premium, if you will. You're always getting to something that you're okay with.
Yeah, I don't really want to take a assignment on anything, but if I had to, I could.
Right. But I think that's the important thing, at least from my personal experience, and it's important to me, is that I'm no longer chasing premium. I'm looking for where I think I can make the most use of my capital in the most efficient manner. So, for example, I know, Dave and Jerry and others are not fans of credit spreads. But where it seems to be working for me, at least right now, is on something like Amazon. If I can get into an Amazon credit spread for a day or two and make 50 or 60% profit on that position, which I've done 2 times in a row over the last 2 weeks. It's not a lot, right? But I'm making some premium off of that. If it continues working for me, I'll continue doing it. Now, is it a good thing to do? Well, with credit spreads as an example, the execution times are much slower because of the way that credit spreads work. So they can also go against you. So they actually say that doing credit spreads is riskier because you actually, in order to make more money, you have to actually get closer to the price of the stock itself. And that's where you can get into trouble.
yeah.
So really different strategies apply to different market conditions and different stocks. There's so many different variables to options trading that don't even account for who you are as a trader and what the account size you have and many other factors. Just looking at a market alone, you can apply different trading strategies to make money. But the simpler that your strategy is, the more chance of success you have.
And that's kind of my thing, right? I found the iron condors and the all these different strategies. I mean, they were the credit spreads. They were a little bit more complex than I'd like to start with. The way I'm thinking, I want to start off with the cash secured puts, get familiar with them, get comfortable with them, and then maybe take it a step at a time. And from what I understand, cash secured puts, that is the most profitable way in terms of, that you're going to get the highest profit doing just straight cash secured put. Am I wrong there?
I can't say that you're wrong there. And what I have heard multiple times people say is selling premium is where you really make the money.
Yeah.
And cash secure puts is, is a way of selling premium, right? Selling premium on the call side can be dangerous unless you can do a covered call. But for example, one of the things that I've been trying to to do more recently is what I'd like to call a covered strangle. And that is basically, I do a cash secure put, while at the same time I have 100 shares of a particular stock and I do a covered call on that. And what that helps me is to get a little bit more premium. The risk that you have there, though, is that a stock can actually go down in price, and this is the case that I have with Tilray right now. So you got to be careful about doing that. But if you're comfortable having a stock like that for a long-term hold, then being able to do both a cash secure put against it to get further into the position if you wanted to, or at least make premium on the put side, and then you get additional premium on the call side. I mean, you can't go wrong there, I think.
Sorry, I want to understand this. So, sell a put and then sell a call at the same time?
Well, yeah. So, but on the call side, I do a covered call because I have 100 shares of that stock as well.
Okay.
So, but like I said, the risk you run there is that your 100 shares of stock, if they start dropping in price, right, then you'll have a harder time actually finding the premium on the call side. And on top of that, your position, your account is going to start shrinking in value because the shares are going down in value as well.
Okay. Interesting. Randy, I'm curious. Do you sell cash secured puts on Amazon? Just straight covered cash secured put on Amazon, or do you do spreads?
No, I do straight cash secured puts, but I don't go anywhere near at the money on Amazon. It's too big.
Yeah. Where do you go? I'm curious.
Let me just look. To be honest, I can't.
Yeah, Amazon is very big.
I got a 30.95 put on right now for May 21.
Yeah. And how do you settle on 30.95?
What's that?
How do you settle on 30.95, 3,095? How do you settle on that? How do you decide to sell at 30.95?
I just picked one. I don't have any fancy sauce or so. I just go down there and grab one.
I love it. Randy. You're so simple.
Actually, Randy, I'm actually wondering. So it sounds like you don't actually look at the open interest at all.
No.
Or do you?
No, not a bit. There's going to be enough open interest on the stocks I buy or sell puts on. There's so much open interest. That's never a problem.
Well, I'm just looking at the May 21, which I think you said is where you have your contract open, and that 30.95 is sitting at 143 open interest, which is surprisingly low for something like Amazon.
Yeah.
Where's the open interest? What does that mean?
Basically, the demand for that contract.
And how do you find out what the open interest is?
It's one of the things. It's just like bid or ask or mid price or out of the money or theta. There's another metric.
Okay.
But yeah, like the 3100 strike is 3021 open interest on that one. So that's why I was kind of curious, Randy, why if you were looking at that at all. But that's the liquidity of a particular contract.
Yeah, but like I say, Amazon's not going to ever have a liquidity problem. I'm sure I looked at it, saw that maybe the premium was a little spiked up on that, so I just went with it.
Gotcha. Yeah, I do like the $3,900 premium. I wish I had the account size to be able to do that right now.
And that's a month out?
29 days, yeah.
29 days, $3,900. That's nice.
And the theta,
First selling at $30.95.
yeah, and the theta burn on that is $148.
A day. Wow.
Yeah.
Look at that. That's crazy.
Right, but
What?
this is where you have to be careful, right? Don't chase the premium.
Yeah. So I'm going to do that first thing tomorrow morning.
Right, because I mean the buy power effect on that, at least on my account, is $44,700, right? So $45,000. If I had a 100K account, even then I probably wouldn't think about doing this one.
Let me check. I'm curious what Amazon is trading at right now.
And you gotta
It's
have a little,
3,300.
you gotta have a little room for it to swing, because it swung down on me today, $850.
Right.
Yeah. Ouch. I mean, 3,300. It's at 3,300 right now. I mean, it would have to go down only $200, and you would be in the money. Ouch. That could happen.
Yeah, so that's why I like doing credit spreads on it, at least on my account right now, is because like the last trade that I did on that, let me see what it was. So I did a 3,200 sell to open and a 3,190 buy to open, and that was 50 cents essentially, $50, and then that happened at 10:45 a.m. and I essentially closed that position the following morning by buying it back for 15 cents, $15, and that happened, at 9:31 a.m. So essentially, less than 24 hours, I made, $35. I mean, it's not a lot, but I didn't really do much.
Yeah, I get that. Yeah, I mean, I love the idea of making $150 on Amazon a day, but honestly, it's not. It sounds really appealing, and it is for anybody. But it depends on your risk appetite. I mean, to see that Amazon was trading on March 13th, it was trading at 1785, so about $1,800. It's trading almost double that, like a year and a month later. I don't know. I think I don't know. You never know what could happen. And I mean, I don't know.
Stay in the market, that's all you need to do.
What's that?
All you need to know is you have to be in the market, and that's it. Everything else doesn't really matter. The market will go up. You just have to make sure you do smart trades. Don't chase the premiums. Don't chase the hype, and you'll be okay.
Yeah, but what happens if '08 happens again, and the market crashes? I mean, imagine owning a Boeing, I mean not Boeing, Amazon at $3,200. What happens for $3,100?
Yeah, to me it's pretty simple. One is I don't go all in on my account, so I try to stay around 50% utilized capital. And what that means is that if the market tanks tomorrow, and I get assigned on all those positions, I actually will hold the stock, right? I'm able to actually hold majority of my positions, if not all of them. And then I can contribute and actually will double down into some of the positions because the stock market is going to bounce back up and I'll come out on the positive end of it. So that's the biggest thing that I've learned for myself over the last, 6 to 12 months is that the market will correct itself. The market will always do things that is not predictable. The market will give you what it will give you. You just have to be at the ready and understand that when something is crashing, a lot of people are panicking, but you have to actually be watchful and mindful of that and buy the right things at the right time, right? You just be ready. Don't be fully invested into the market. You go down with the ship.
Yeah, I get that. Um, if you could sell a put on Amazon and you had, let's say, if you were playing with your, if you could have, whatever, say $1,000,000, where would you sell? Where would you sell a put on Amazon? I'm curious.
If I had that much money and I was interested in touching Amazon, I'd probably be wheeling it, meaning that I'd be closer to that the money.
Mm-hmm. Okay.
But that's based on the fact that you get higher premium, and I'm okay with taking assignment.
Yeah.
Right. But
interesting. Well, I mean, if you had $1,000,000, you 330 grand would be 300 grand would be going to one assignment.
Yeah, well, yes and no, because you're actually dealing with margin, right? So technically on something like IB, it's 4-to-1 leverage, so you're only paying, what is it, $800, $900?
Yeah. And then you're in leverage, and then you don't really have control as you had before.
Well, no, I mean, if your account is $1 million, you're not you're not in margin, right? You're not paying the interest on it. It's just and you turn around and wheel it. So as long as it doesn't take.
Why would you wheel it instead of just selling cash secured? Which I'm sure you've got a reason to want to do it that way instead of just doing CSPs.
Because you can double your profit. You're getting premium on both. Yeah, you're getting premium on both sides.
On the coverage call and the put.
Correct.
So, but when you take assignment, you would sell the call once you take assignment, right?
Right. If you're wanting to do covered call, then yeah, you definitely need to have the shares. So you would sell a put, wait for it to be assigned. Once you have the shares assigned, then you essentially start doing a strangle, which means that your put side is going to be cash secure put. You get premium for that, and then your call side ends up being a covered call, so that you protect yourself from the stock popping.
So a strangle is pretty much, is that part of the wheel?
The wheel typically is you sell a put, and then once you get assigned, you sell a covered call, and then it sells that. But if you're comfortable with the stock and you don't mind holding the stock, and you have enough cash in your account, then essentially you're doing a wheel, but at the same time you're doing another cash secure put to potentially be able to continuously keep doing that.
How does that work? I mean, I understand the wheel. Let's say you get assigned, you sell a put on Amazon for 3 grand, let's say. You get assigned, and now you are doing a coverage call, let's say for $3,100. And then if it gets called away from you, you get your premium. I think you get your premium anyways. So you keep your premium, and you've sold your stock for whatever price you agreed upon. But when you're doing the strangle, what are you doing? I mean, how does that change the equation? Are you still doing the same thing, but also selling a put?
Yeah, I mean, a strangle is nothing more than a put that's out of the money, and a call that's also out of the money.
So when you're doing a strangle, are you doing everything I said before about selling a put, selling a stock, not selling a stock, what am I saying? Selling a put, let's say on Amazon for 3 grand, getting assigned, and then doing a covered call on that, selling a covered call on that, and also doing something else, or is the strangle independent of that earlier process?
Well, a strangle by itself is a put and a call position on at the same time. But I don't feel comfortable on the stocks that I have and the account size that I have to be able to do naked calls. I don't think that's a smart thing for me to do at this point in time in my trading career. So to mitigate the risk of selling a naked call, basically I make it a covered call, right? Which adds a different type of risk to my portfolio, which is if that 100 shares of that stock start going down, essentially the portfolio value goes down and I lose money there as well, right? But that's why I try to make sure I do it only with shares that I don't mind holding long term, and I think they're going to recover at some point in time.
Okay, I see. So I'm sorry, I don't mean to harp on this, but you said with Amazon, if you had, whatever, say $1 million in your account, you would go, you would do a strangle. That's what you're saying you would do on it?
Yeah, probably. Well, to be more precise, I said I would do a wheel, right?
A wheel, yeah.
Yeah. So.
A wheel and then incorporate a strangle? Is that what you said?
Well, a wheel is you sell a put, wait for assignment, then you start doing covered calls. But if your account size is big enough and you want to keep making premium and don't mind having another put on at the same time, right? Then you can actually keep making even more money because you no longer just have the call side, the covered call side on. You actually now are still potentially making money on the put side as well. So
that's what a strangle is.
Right. Well, the strangle is naked call, naked put, right? But I'm just covering myself by having 100 shares of that stock.
Interesting. So I mean, with the strangle, you're taking the chance that you could potentially end up with 100, 200, 500,000 more shares, depending on how many you're selling.
Well,
if you can assign.
Not thousands of shares, no.
No, depending on the size of the contract.
Yeah, I would never get into a contract that would put me in a position to have that many shares assigned, because you're essentially multiplying your risk, which is not a good idea.
Yeah.
With each additional contract, the highest size of contracts that I ever went to was 2, and that's on the covered call side.
Interesting. Okay. Yeah. Very interesting. And now let's say you did a spread on Amazon, right? A spread, you're saying basically, what is a spread? If you can kind of summarize it for me.
Sure. So a credit spread is essentially where you sell a put, for example, at a higher price, and you buy a put at a lower price, and basically your premium is the difference between the two.
So you're pretty much you're limiting how much you can make by doing that, aren't you?
You are, but you're also limiting, in theory, your risk, right? Your max loss.
Interesting.
So not only that, but you also control your buying power. So without a credit spread, I would never be able to get into an Amazon position.
You need a 6-figure account to do that.
I would need a Randy account, yes.
And a Randy mindset too. Randy's the guy. Randy's the man.
Randy is why we're all here.
Yes, I agree. We got to be thankful. We're learning quite a bit from this, so this is perfect. Okay, cool.
All right. Well, this was a fun conversation. Hopefully, Randy, you'll be able to actually upload this if you are still recording. I'm not sure.
Yeah, I'm still recording it.
Okay.
I'm just waiting for you guys to
All right.
finish. And then I'm going to find my place and
Sorry. Sounds good. All right. Well, thanks for the conversation, guys. This was really fun.
Have a great night. It's been nice talking to you all.
Yep, you too. Take care.
Bye bye.
Bye.